You to the midweek roundtable. My name is Roger Scott. I'm the head trader for Wealthpress, and my guest today is Jeff Zananiri. Jeff, welcome. Thank you for being here today. Pleasure to talk to you as usual.
What's up, Roger?
We've been getting a lot of, you've been getting a lot of positive emails, and I've been getting a lot of positive emails. And one of the things that people really like about these sessions that you and I do is that we're extremely spontaneous, and it's very obvious that it's not scripted. So people are really loving that part about it. And again, Jeff and I do not talk. We don't go on our Skypes and say, what's the plan for today? This is completely just off the top of our head, things that we are thinking as they come along. So I want you guys to know that this is completely off the script. So what are you seeing, Jeff? What are you seeing in the markets today or this week?
Well, today is a really interesting day, because we got this amazing virus vaccine news from Moderna. And that came last night, actually.
Yeah.
And we saw the S&P futures bid up almost 1% in the evening, which if you follow the futures and you follow what a normal move is, that's about a 2 standard deviation after hours S&P future move. So I was like, ooh, that's interesting. We should get some follow through. But then today, we're seeing FANG stocks, we're seeing some of the big winners that you and I have been talking about for a long time are not participating in the rally. And what's rallying today are the opening of the economy stocks, the stocks that have been getting killed, the hotels, department stores, airlines. I'm looking at a list of them here. Food distribution index, leisure. These are the type of stocks that are rallying today. What's not rallying today? Semiconductors, internet, so it's something to pay attention to, because we've spoken about it for the last month and it's played out almost perfectly, is that people keep thinking that there's going to be this rotation from these really red hot, and we talked about this on Monday and we were spot on, because that day you had another huge key day reversal and they started selling off in the NASDAQ, and people think that the baton is going to be passed, like this beautiful marathon that's happening. And these big winners that have real money flows actually going into them are going to just hand off the baton to these dogs of the Dow type of stocks, and the market's going to be led by that. And I would say that's not so fast, my friend. If you start seeing selling in the real winners, the buying in the losers is going to be short-lived still.
Very much so. And as a matter of fact, I think you kind of said what's happening, but you didn't give the conclusion. I just wanted to put a nice little bow around what you did. Is
the volleyball serve.
Yeah. What Jeff is alluding to is that, if there's a vaccine, then things should go back to normal. Then there shouldn't be a premium anymore for the stay-at-home tech stocks, which have been the FANG stocks and so forth, which have been going up, the QQQ stocks, which means we should be seeing money coming back into the regular stocks. And that is true if you're looking at it on a short-term basis. But on a long-term basis, we can't go back and undo the damage to the economy that happened. So ultimately, all of it is going to go the same way. So these little bumps that you're seeing right now are what they are, bumps. These are not a change in rotations.
No, beautifully said. Beautifully said. I think it's a warning sign for the broader rally, which has been super top heavy in a few names, which are not continuing. The point that I'm making is we're less likely to see a continuation in the broader indexes up, with the losers leading.
And just to add to what you just said is, and we're also seeing heightened sensitivity in defensive assets, non-correlated stock assets, which only adds strength to the argument that you and I are making right now. So I am seeing everything exactly the same way. Interestingly, beginning of the week, a lot of traders, because, I do a lot of videos, you do a lot of videos, we go live a lot, we talk, and we repeat ourselves a lot, because the markets don't change day to day. They could be doing the same thing for 3 weeks and we'll be singing the same song. But that just, I don't look at that as bad. I look at that as being consistent.
Yeah.
So what I started telling people was, I got an interesting story here for you. So I was telling people, look, the same thing, the same story. Lighten your load. We're going into earnings. Volatility is going to start spiking back up. We're going to see a lot of bank stocks. We're going to see a lot more washing out. We're going to see a lot of, I don't know if you saw Wells Fargo down 2.8. Just terrible.
Yeah, but as we had said, did you see Goldman's trading earnings today? They made $6 billion trading bonds and fixed and commodities.
So Craig and I yesterday, based on the conversation that you and I had about the investment stocks, bank stocks that are going to do well versus the versus the savings and loan types.
Yeah,
we were looking at them yesterday. Goldman's looking great. Have you seen Morgan? Morgan's looking really good. Like
my man,
really good.
I just put on a money link in Morgan. I
had no idea.
This week, I just
had no idea
because of the chart. I liked it, so it came down. It came down Morgan or Goldman, and I took something you talk about a lot, which is this lengthy digestion consolidation period at a nice high level. Usually leads to a super breakout. And Morgan just had a nicer consolidation for a longer period than Goldman. Goldman had some turbulence. I still like Goldman, but I preferred Morgan. Morgan was a better chart. I like the fundamental case for both, but Morgan was a better chart. So I pulled the trigger and I put it on this week.
I had no idea. See, this is very important.
Monday.
Like if you and I are seeing the same thing and we're from a different perspective. Yeah, yesterday we were in the trade room and we were just kind of looking at all the bank stocks, and I said, but look at the difference between the savings and loan type of stocks versus the ones that are investing. The ones that are investing are actually doing good, and then that led us to the conversation about Morgan and Goldman, and we compared the two, and I came again to the same conclusion that you and I just did, because I like that long congestion with the breakout. And another thing you may want to add to that analysis, that, by the way, for anyone listening who's not familiar with this, Jeff and I are talking about what I like to see before a breakout, I like to see a nice congestion. A nice congestion leads to a good breakout. But one more thing I like to add to that is I like to see consistent volatility. So in other words, if you're seeing congestion, but you're seeing a lot of spikes in volatility, that's not great. But when you're seeing volatility and congestion around the ATR around the same level, that really leads to those nice runs.
What you just mentioned was the disqualifier for Goldman. It was an inconsistency in the volatility. Yeah. You had it like every third or fourth day, you would have an outsized move. Yeah. And I just didn't like that. I didn't like that.
No, I think you did a very, very good choice. So let me finish this discussion. So I was thinking, I'm always thinking, how can I help investors? How can I help investors and traders? So I was saying gold, commodities, but I was reading an article on Seeking Alpha the other day. And they were talking about this ETF, WCLD. And I was looking at it. So I looked at the top 5 holdings, and I was like, oh, it's a cloud. It's a cloud. I've been really big on the cloud.
Nice.
Almost every stock that I recommended, D-Dog, Net, Cloudflare, now literally 9 out of 10 stocks that I recommended were in this ETF. So what I did was I decided to go through a list, and because that's another thing I think investors should be doing. I think a lot of investors right now, I think we're going to see some choppiness, and I think when we're seeing choppiness, it's best to be defensive, and I think it's going to be best if you allocate. It may be best right now for traders who still want to be bullish and still feel the market's going to go up. I think it may be a best idea right now to potentially walk away from individual stocks for the next maybe few weeks or a month, and move into some of these other ETFs. And I'm going to mention a couple to you that I'm looking at right now, and I really like these. So I want to give you the ticker symbols, and I want to give them to you, and I want you to tell me what you think.
Yeah.
First one is Robo. It's a robotics artificial intelligence fund, ROBO.
Nice.
Again, very much into NVIDIA type of companies that are looking to make self-driving cars, 5G. things that are becoming more independent.
I like that.
I like this fund, and I like the chart. I like the way it's looking. The next one was ACES. ACES was, let me give you that one here. Let me just bring it up. This was the clean energy. I think we're going to see a lot of clean energy. You and I were talking about how a lot of people think Tesla is a car company. Folks, it's not. It's the largest it's alternative energy company. And that's the number one holding in this. Yeah.
It's the ESG. It is the ESG fund. If people want to know what's the biggest ESG fund in the world, it's Tesla Motors.
Yeah. Yeah. And then another one, I really like this one. Besides the one I already gave you, WCLD, the other one is DTEC. And this is interesting, Disruptive Energy Fund. All right.
Putting them in my phone here. Hold on. Just say that one again.
Yeah, disruptive technology, ticker symbol DTEC. DTEC.
That's awesome.
Spotify, Square, Alarm, Descaler, Splunk, Dexcom, literally like all the stocks that are truly causing a disruption to the technology sector with brand new innovations. So what I'm thinking is, if people are still very interested in the stock market over the next month or two, or at least till we're done with earnings, and you want to be in stocks that could potentially rise, or you still could see a lot of money moving into, these four funds, I believe, are very good if you are still very bullish on the market, but want to stay away from the bumpy road over the next few months.
Well, one thing I really love about what you're saying is, and I don't think you mentioned it, I'm going to put a little bow on what you just said, is you get a lot of single stock name risk in earnings season. So your thesis might be correct, but sometimes the stock gets hit on earnings, even if the earnings are good, specifically after you've had a huge run on the upside, which a lot of these names have. A lot of them have.
Oh,
so
yes.
When you get that broadness of diversification, it smooths out some of that single stock volatility you get in earnings season.
Thank you for saying that. Thank you for saying that, because I did completely miss that. And yes, that is the point of all of this. I kind of did exactly what you did. Sometimes we get so into our thoughts.
No, you did a great. You explained it great, but there's an aspect of it specifically in this point in time that makes it super smart.
Yeah, volatility, diversify. You're diversifying, and these. And again, I'm not suggesting you should put your life stakes into these funds, but if you're right now bullish, and right now single stocks, it's like being on landmines right now.
Can I tell you something?
Please.
So in my money links in my service, I have two different buckets, two different portfolios. One is a little bit longer term, but by longer term I mean like a month. Maybe a month and a half. And that tends to concentrate more with single stocks. And I do a weekly swing trade. And in the weekly swing trade, I tend to skew much more to ETFs. Why? Because if I get a news bomb in a stock in the middle of the week, it's going to be almost impossible for me to make back that money in a week. So I open myself up to a lot more single stock risk in a short period of time. That's something people should know too. The
very important, folks. Pay attention.
The shorter your time frame, the more benefit you have for going for more diverse, wider indexes. There's a reason that the S&P future trades 10 times what the SPY does in liquidity. Because when people are trading real short term, and they just want to get the market right, they're trying to eliminate as much of the extra risk out of it as they can. So what you're saying is something that I intuitively do, and I have done as a professional hedge fund trader for my entire career, because that's just how you do it. But also, when you have a good fundamental thesis like you do, you need to give it time to really work. Why would you try to just scalp something that could move 3x, 5x, 10x with just the risk aspect in a short period of time? That happens over a long period of time. So I just wanted to add something. There's a little trader training I wanted to throw in there in general.
I appreciate it, and you're 100% right. And folks, what Jeff just said is worth its weight in gold. That's the difference between a retail trader and a professional trader. Just these little things, how we value risk, how we look at a time period for the investment versus the risk it can incur. Comparing risk versus reward on a scale basis of time, because if something goes against you and it's a short-term trade, it's going to be longer for you to get out of it. So
Right.
there's these ebb and flows. Again, the more you listen to Jeff and I, the more you will absorb this in, and the more you will be able to apply this to your own trading, and that's really, really the key. Now, before I let you go, a few things. Disney reopened, as you know. We talked about Disney. By the way, I shorted it on Monday and made about 60% on the put option, but I'll save that for another day.
I love that.
What's your opinion on the summer, on Disney stocks, on these stocks that have to do with, going back to reality and pretending?
So I have a lot of buddies.
Not there. Hospitality.
So I'm going to be very anecdotal with some of the things. I'm pessimistic on the real economy and on a V-shaped recovery in terms of life just bouncing back to normal, lickety split. Even with the vaccine, it's going to be like this long duration where the vaccine can only be produced and distributed to the most vulnerable, the comorbidity people, the elderly. And so before we have mass vaccination, we're looking probably at about a year and a half. The psychological damage over things like going to a theme park is really deep. The psychological damage of like going on a cruise is really deep. These are things that are going to take a long time to heal and to recover. People are going to have to feel extremely safe, like the coast is totally clear before that breaks back to normality. Also, I have friends that work in the city in Manhattan that are big fund managers, and they're like, nah, I'm not going back in 2020. I don't care. I could have a cabinet full of remdesivir, and I could have hydrochloroquine coming out of my eyeballs, and there could be a vaccine. I don't need to go back in the city. So why do I say that? That's a different question, because the answer is that the psychological effect on people is profound. It's profound.
And I'm going to tell you something that hits close to home. My parents, they're in their early 70s. They love cruises. I can't stand cruises. I like to move around a lot. It's not for everybody. Right. But my parents love cruises. They're not adventurers. They like to just sit there with a book and read. And I send them on cruises maybe 4 times a year. So I talked to my mom yesterday, and I said, Mom, so let's say that this new drug comes out. We were having this discussion last night. I said, would you be okay going on a cruise? She said, I'm not going on a cruise for at least 2 to 3 years. And this is a woman who would never say no to a cruise.
Right.
Exactly what it's in here. It's a deep wound. So yes, it's going to take some time. It's going to take some time. It's not going to be so you also believe that we're going to have a very selective recovery in terms of certain stocks just going crazy good. And you don't think it's going to be a broad ocean.
That's where we've been where we've probably been repetitive and we've been banging the same drum. So to go back to my original thought of this rotation, I'm more looking at re-entering those winners at optimal times than flipping into the ones that I don't believe in from a fundamental case. So what I'm saying is when I look at the markets, I have like a list of these are longs, these are shorts, these are no plays. Then with the longs, I have scenarios where I would get long and how much I would put in. Same thing with shorts. It's very rare, and it takes a long period of time for something to go from the long list to the short list or from the short list to the long list. So for instance, with Disney is on the short list. And you put a short on it, but it would take a lot for Disney to become a long for you, right? It would take a whole lot. It would have to be so deep value that they'd be selling Cinderella at 30 cents on the dollar.
The world would have to completely change. The dynamics of this, everything would be like maybe a year or two from now. Yeah, it's not going to be
super deep value. It would have to be so undervalued that their entire portfolio of properties, including Avengers and everything, would be
30 times book value, 30% of book value, something like that.
Yeah, exactly. So those same scenarios like we had in the bank. So you see what I'm saying? And so I think that we're going to have selective recovery. We already have winners. We already have losers. And I just think it's going to actually get more pronounced as time goes on. remember, this has been a short-lived crisis. Most crises last 18 months.
At least 18 months to 2.5 years. Yes.
Yeah.
Absolutely.
And so this has been like the most short-lived one ever. So we don't really know how it's playing out, but we have historical precedent for the cycle of how they go.
Last question for you for today.
Hmm.
And I'm going to get a little political without getting personal.
Okay.
Do you think, so don't feel like you have to, this is just from a perspective of how it impacts the market.
Always.
Do you think it's wise for the administration right now, in light of the current economic uncertainties, do you think it makes sense to get back into the trade war, or do you think it makes best sense to kind of because I think the government's making a mistake right now. I think based on where we're at, I think it would be best to kind of forget about this trade war till things start picking back up. So, but I don't think anybody's listening to me.
No, I mean, I think you're right, but I think that if you look at like how it's gone, it's been I'm a poker player. I'm a poker enthusiast. And to be good at poker, you have to bluff. You have to learn how to steal pots. You have to learn you have to have that component to your game. And a lot of people criticize the administration for being a little bit erratic, et cetera, et cetera.
A little too aggressive in light of what we're seeing.
But I look at the totality of what they're doing as this game theory, like poker strategy. And so what I'm trying to say is I don't think they're going to blow up the trade war, but I think they're constantly playing a game of brinksmanship to do what they need to do. So I don't know if I answered your question directly.
You did.
I don't think they should be doing it, but it doesn't matter what I think they should or shouldn't do.
You think it's more? You think there's a lot of posturing here, a lot of posturing.
This is an important point, and a lot of traders have this wrong. It's not important what I think should happen. It's more important than what I think is probably going to happen, most likely to happen. So if you look at a pattern of their behavior, that's what they've done. The pattern is talk the game, take it right up to that point of chicken, and then pull back, and then pull back. So I expect them to always pull back at that last moment, but I expect them to keep pushing also. So yes. I don't think it smooths out anytime soon. I think it's going to be just a continuation of the same thing.
Agreed. I wanted to see what you would say. I wanted to see your opinion. But yeah, I think you're spot on. And President Trump, as we know, loves to posture. So
yeah. But a lot of people, Roger, get caught up in, playing like the omnipotent decider for the markets, for politics. And it's like, when you become a real market player, a market observer, an investor, a real trader, you really have to, we all have biases. We all have opinions, but you really have to remove what you think should happen and take away your value judgments and try to identify the pattern of what is happening. Agreed.
And Jeff, thank you once again. And on this note, let's finish on this note, because this was a very, very good session. I think we gave a lot of value, a lot of insight, and I'm very happy that you and I are seeing things in a very similar way. Because if we're not, then it's a good time to kind of, that may be a good like check and balance point for us to revisit. But yeah,
it feels like we're old colleagues. These are the kind of conversations I've had with mentors, with with junior guys I brought on, with partners that I've had. It feels like the type of conversation I've had, and I hope you'd feel the same way, that you've had for 20 years about this game.
Completely.
Because when you get that reinforcement from a quality opinion standpoint, it just gives you that much more confidence that you're seeing things correctly and to make good decisions.
100% agreed, my friend. 100% agreed. Again, Jeff, thank you very, very much. I will see you either on Monday or Wednesday when we do the session with James West. And I hope you have a wonderful week ahead. I'll talk to you soon. Thank you once again for being here.
Thank you, Roger. LFG.
Take care. Bye.
Bye-bye.